Have you ever heard of whole life insurance being used to finance real estate or used to enhance your real estate portfolio? Well, whole life insurance has been used for real estate investors and is today, it's very popular. The thing is, where so many people get into trouble with this or have buyer's remorse is investors purchase whole life insurance policies based on the concept or idea of using a whole life insurance policy to acquire more real estate or enhance their portfolio. Specifically, what they are attracted to is that with a whole life insurance policy, when one looks at the cash value, once a dollar passes through that cash value, if you just let it sit and grow, which is a great alternative to money sitting in cash because it'll produce between 3 to 5%, it's safe, liquid, tax-free as well. But if it grows at 3 to 5%, or if you borrow against it, if you pull money out, it keeps compounding at that 3 to 5% rate as if you never touched it in the first place. There's no lost opportunity cost. That's where the attraction is. So often people will say, okay, I want that. I had no clue you could do that with a whole life insurance policy. But then they get into it, and after the excitement phase has passed, once they've paid money into the product, they kind of step back and look at the numbers and say, wait a minute, why am I doing this again? It just doesn't make sense. I've got a negative hit. It takes forever for me to see a return. Like there are other things I can do with my money. Can I get out of it? Nope, too late. So if I have the awareness up front, I can prevent a bad situation from happening. So I want to share a story in this video. Earlier this year, I met a young man. He was 31 years old at the time. He's 32 now. We're a year apart. I'm a year older than him. So I call him a young man, but really we're the same age. He is into real estate investing. He does very well for himself. A single guy, earns north of $500,000 per year. And by the way, you would never know it from talking to him. He is extremely humble. That's one of the reasons I like talking to him so much. He doesn't boast, doesn't brag about the money at all. He does it because he thoroughly enjoys it and the money comes. Now, with that said, he was doing research on real estate investors. He found a coach that he really likes that provides a lot of information, has online courses specifically on real estate, and this coach talks about whole life insurance, how he personally, the real estate coach, purchases whole life insurance policies, flows his money through the policies, and then uses the cash value to then purchase real estate. So of course, the client then, this individual says, well, I want to do exactly what the coach does. It's working for him. How do I copy that model? So he's introduced to a group that works with this real estate coach that presents and sells him on whole life insurance policies. And they're really selling the concept to say, hey, this money in the cash value, you can use it anytime you want. You've got all the benefits and features that the real estate coach has. You're going to do great with this policy. He's excited, he gets into it. However, here's the problem. He opened that policy with a small company, which as far as he knows, all companies are the same. And then second, had a very, very high base premium, which we talk about in a lot of our videos. The base premium does not show up in cash value in the first year with most traditional products. It takes a long time to see any value in terms of your cash value. Single guy, doesn't care about the death benefit, interested in the cash value and building his real estate portfolio. That's what he's interested in. Now the focus when he purchased this policy was again, not on the net cash value. The focus was on, hey, look at this dividend column and look at what you can do to enhance your real estate portfolio. You're going to make so much money just like the coach. Again, selling the concept, selling the dream, neglecting the numbers. Some people see through this. A lot of people don't, and we've seen smart, sophisticated investors even fall down this pit or go down this road. And it happens, frankly. So kind of the closing statement that this individual shared with me is he was told by the sales agent, the financial services professional, that, hey, you've got the same policy that this real estate coach has, this investor. You are set up for success. Now, as he reflects back on that today, he kind of says, yeah, right, there's no way this guy puts that kind of money into one of these products that takes 10 plus years just to break even. What was not touched on at all was the commission, which we will touch on as we go through this. Let's get into the numbers here. So here's a policy. I'm not going to disclose the company name, But here we've got age 31, standard non-tobacco rating. What do you see in the monthly premium over here? $62.50 times 12 comes out to what? $75,000 per year. So that's what he is committing to. That is his underlying base premium on the contract. It's technically a little bit less, as a part of that is the term insurance rider. That's high. When we talk about a 10/90 split, that minimum base premium, if I'm paying in $75K per year, I'm going to have a $7,500 base premium. If I have a $75K base premium, that means I want the ability to pay up to $750,000 per year. So that's a high base premium. Here's his payments. The first year, $125,000 goes into the policy. Based on the guarantees, cash value is about $76K. However, based on the non-guarantees, we see a dividend in the first year and a net cash value of $82,000 and change. That's his actual value in the first year. It's about a $42,000 hit if you've got a calculator now and you're doing the math. Excuse me. So that's a big hit. 40 grand on his money. He's 31 years old. Could you use $40,000 to invest in additional real estate that'll produce a higher return than the policy? The answer is absolutely yes. So that is what business owners and investors look at. Every single business owner that I talk to, same thing with real estate investors, that has seen this in the past, high cash value life insurance, and not moved forward with it, has been due to this, the opportunity cost. I can do more with my money today than what this negative hit looks like right off the bat. It just does not make sense. And they're told, hey, just focus on the long term. And they're like, no. I grew my business by using capital up front. If it's too much of a hit, I'm not going to do it. So can you make it better? The answer is absolutely yes, and it 100% has to do with the policy design. So let's take a look at what he did. So the good news about this is we were able to catch this only a couple months into the policy. So he did take a hit of a few months premium payments, which adds up quite quickly. But as we examined everything to make sure, hey, if we exit this policy and get into a new one, how much time does it take to make up for lost time? Because he's got to walk away from the payments he's made already. Does it make sense to just keep the policy perhaps? So let's take a look here and see what we got. Small company on the left. Let's zoom in first. Here we go. So this was the illustration we just looked at. What do we see here? $125,000 in the first year, $82,000 in cash value, the growth, negative $42,000. Now that cash value growth, what that represents is the net growth we see on the cash value each year. So for example, year 2, you see negative $17,323. What this represents is the fact that he pays in $75,000 and the cash value grows from 82 to 140. What that means is he paid in $75,000, and of that $75,000 payment, he lost 17 grand. Year 3, he loses 13 grand on that payment alone. Finally, by year 7, he pays in $75,000, he gets the $75,000 back, and another $1,000 on top of it. So finally, by year 7, he's seeing more growth on his single payment each year. And that $75K is all premium, a little bit less. So we see this drop from 75 to 73 to 72 in year 8. You'll see the death benefit drop as well. So what happened here is the term rider fell off. It was a 7-year term rider. This is exactly what's going on. But when the term rider fell off, the term premium dropped as well. So that's the actual base premium here. And in yellow represents his break-even point. 12 years. He's got $941 in payments, and in total cash value, $945. 12 years just to get his money back. And he funded it for a total of 20 years up until age 50. That was his planned funding. So, does that make sense, being that he can enhance his position with real estate? I say, no way. Don't make sense. Like, why would I wouldn't do that with my money? So here's what we looked at. First, we asked the question, well, as we look at different policies, if we were to just kind of reverse time, how much would you want the ability to pay into a policy if you saw your cash value up front and you could use it for real estate right away? How much would you want the ability to pay in so you wouldn't have to go through those early expenses again? Because this policy, the most you could pay in was $125. If you wanted to pay in more, what would have to happen? Well, this is where we'll consider another policy, repeating this process, which he didn't want. So he wanted the ability to go up to $300,000 per year, but he didn't want to get a bill for $300,000 per year. So how he designed this guy is with $30,000. So I'm sorry, a $30,000 base premium is how we designed this. That's what he is committed to each year, a little bit more with his term insurance rider as well, but committed to the minimum, and he has the ability to go up to $300,000 per year. So now he's not billed for $75,000 per year. So think of it this way. Over here, he can pay up to $300,000 per year, but he's only committed to $30K. And with this guy, he's committed to $75,000 and he paid $125 right off the bat. Definitely lopsided, and that's why you see a big difference in the break even as well. So the actual break even point on this guy is highlighted in orange. But I want to focus on this yellow here. Whenever we look at a 1035 exchange, what that results in is one walking away from the payments they made into the other policy. Meaning, say at the end of the first year, he exercised a 1035 exchange. He would have paid in how much? $125,000, and he could roll over $82,000 and change. So if you're the consumer and I made that recommendation or I mentioned that to you, what would your reaction be? Well, I roll over the $82,000, Steve. I paid in $125. What happens to the other $42,000 that I paid in? Is it just gone? The answer is yes, it's gone. That's what we like to look at when it comes to a 1035 exchange. If I were to measure the numbers, it's going to be close, but I would bet that there is or very close to more cases that we have recommended not to go forward with a 1035 exchange than there have been 1035 exchanges. Because what I want to look at is if we walk away from 40 grand, how long is it going to take to make up for that lost time? In this case, it made sense because the designs were so lopsided compared to what he wanted to do and what he actually got. For example, what we did here, cumulative payments, year one, we actually made $425,000. So he paid in, and this is an assumption here, 300 grand in this option, but why we made it 425 is I wanted to account for this $125,000 payment as well. I know we're going deep here, but I want to factor that in to make sure it is in the client's best interest. If it's not, we're going to say, hey, keep this. We can attempt to make some tweaks with it. Maybe we don't even look at a new policy because it just doesn't make sense. Let's see what revisions we can make here. But in this case, we did try that actually to make revisions with that. He got a ton of resistance because the premium was so high. So this move ended up making the most sense. So with that said, accounting for the additional 125, here's the break-even point. Year 5. Let's look at something else here. The guaranteed values. What do we have? And this accounts for the 125 as well. The new policy, year 6. With the old one, what does that look like on the guarantees, which we pulled from that illustration we had up? When you see yellow, that's when we break even. Year 24, policy design. Now, we always talk about the big four, the 4 major mutual companies. I'm going to add, with this small company, it can be designed with a more aggressive split than a 1090. I've actually modeled with this. The lowest I ever got was right around a 3.5% base premium and everything else into PUAs. We had to have a huge term rider and it didn't make sense in that case, but that's as aggressive as we were able to design it. The company will allow it too. So it's not as if it's just performing so badly because it's a small company. No, it's the design really on this one as well. So guaranteed, non-guaranteed, when we look at that hit, And the guarantees would be a $49,000 hit up front. The question is, can we make up for it, make up for lost time? And in this case, the answer was yes, absolutely, based off how he wants to fund the new policy. And it would be very similar if we were funding it at $125,000 per year. We would just kick the base premium down to $12,500. Let's touch on the last thing here. So the premiums on these examples were what? $75,000, $30,000. Now, what I'm going to add here is smaller companies, like this company, actually pay a commission rate of 130% on base premium. This company is a larger mutual company, tops out at an 85% rate on base premium, which shows you a lot of times the motivation between using a large company that does offer business in the state of New York versus one that does not. World of difference on the compensation, just as far as the total rate's concerned. But as I look at this, what was the base over here? 75K. So take 75K, 100% is what? $75,000. So take 30%, 22.5 plus the 75 gives you 97.5. There was a PUA payment as well. Commissions are small in PUAs, but there are commissions there. Close to $100,000 commission on this. That's a whale of a sale, if you want to use that expression. What's it on this guy? Base premium was what? And these are estimates. The commissions, the net commissions will be a little bit different on these, but still, 85%, 25.5. And you're putting in a significant larger amount of money. If you really want to be fair, we've got another $270,000 toward PUAs, and this company pays a 3% rate on PUAs. $8,100, add it to the 25.5, there you go. Even if you try and get it closer, $30,000 and change compared to the $100,000 policy. But which one has a greater consumer value? Big difference there. So when it comes to full transparency, sometimes it is important to understand how commissions work, what's motivating the sale. And I'm not saying that all small companies and agents are bad. No, there's times we work with people, and I talk about the 4 major mutual companies all the time, but we look at the situation, they've got an old term policy with a small company, we convert that to whole life because it makes the most sense with that small company. Maybe they can't roll it over or convert it to a larger company, and they've got health issues, whatever. I don't want to go off on a tangent there. But if I'm the consumer, this is the kind of stuff I want to be aware of. So this individual we're working with, he wants awareness on this. Now he has it, and he's set up to succeed. He actually sees value right off the bat that he can use for his real estate portfolio. Still has that hit right off the bat, but still positive way earlier on, sees the value and says, okay, I got the hit, but I'm okay with it because now I actually see it move forward. And it's not an $80,000 hit. Well, it is close to that with a 1035 exchange. But anyway, we can get into the numbers another time. Hope you enjoyed this one. If you have questions, feel free to reach out anytime. If you enjoyed, please hit the like button, subscribe for more, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.